Welcome to our comprehensive guide on capital structure. Capital structure, the mix of a company's debt, equity, and other financing sources, is vital to financial management. Today, we'll explore why it's important, how it's calculated, its impacts on business decisions, and how to optimize it. Capital structure refers to the way a corporation finances its assets through a combination of debt, equity, or hybrid securities. Essentially, it's the ratio between a company's funding from shareholders and creditors. Let's start with a basic example. Suppose a company has $2 million in debt and $3 million in equity. Their capital structure would be 40% debt and 60% equity. Now, let's take a more detailed look into the components of capital structure. Debt can come in various forms, such as bonds and loans, while equity typically includes common stock and retained earnings. Companies must decide the right mix to minimize cost and maximize value. But why is the capital structure important? It influences a company's risk profile, cost of capital, and returns on investment. A well-optimized capital structure can lead to higher company valuation, efficient use of resources, and greater financial flexibility. Let's look at an example of how different structures can impact a company. Suppose Company A and Company B both need $100,000. Company A uses 50% debt and 50% equity, while Company B uses 80% debt and 20% equity. The weighted average cost of capital, WACC, will vary between these companies, affecting their profitability and valuation. Here's some data on how capital structure has varied over time for different sectors. For example, the technology sector often has a lower debt ratio compared to more capital-intensive sectors like utilities. Let's discuss some common questions around capital structure. Question: what is the trade-off between debt and equity financing? Answer: debt is cheaper due to tax deductibility of interest but increases financial risk. Equity does not burden the company with fixed payments but can be more expensive due to the cost of equity. Question: how does a company decide its optimal capital structure? Answer: companies typically perform financial analysis and scenario planning to assess how different structures affect their cost of capital, risk, and returns. They also consider the current market conditions, regulatory environment, and their overall business strategy. Let's move on to some real-world examples. Tesla, for instance, has a capital structure heavily weighted towards equity. This is because they constantly raise funds through equity to support their growth and innovation strategy. On the other hand, a company like General Electric utilizes a significant amount of debt, reflecting its stable cash flows and the predictable nature of its business operations. Now, let's dive into the Modigliani-Miller theorem, which states that in an ideal market without taxes, bankruptcy costs, and asymmetric information, capital structure does not affect a company's value. However, real markets are far from perfect. Practical considerations for capital structure optimization include evaluating the trade-offs between tax benefits and bankruptcy costs, assessing the firm's business risk, and understanding market conditions. Companies must balance the interests of shareholders and creditors. Let's take a closer look at how leverage impacts a company's earnings per share. If a company uses more debt, it can increase earnings per share in profitable times, but also amplify losses during downturns. Here's a graph showing the relationship between risk and return for different capital structures. Generally, as debt ratio increases, both the potential return and risk also rise. In conclusion, mastering capital structure is crucial for financial success. By understanding and optimizing the mix of debt and equity, businesses can lower their cost of capital, maximize their value, and effectively manage risk. Thanks for watching. If you have any questions or need personalized advice, feel free to reach out or leave a comment below. Don't forget to like, subscribe, and hit the notification bell for more finance tutorials.